Hey, what's up guys? Bob Johnson, Bob Mortgage here. Hey, I'm so thankful that you've taken the time today to watch this home buying event. Okay, look, I've been doing this for a little over 23 years now. I've been very blessed to provide financing to over 26,000 families. And my goal here today is to educate you. I want to make sure that I bring so much value to you so that you can actually move down this journey and find ways to transform your life. Look, transformation of life happens multiple ways: emotional, physical, financial, and spiritual. Today, I want to go through the financial transformation for you so that we can move you closer to the dream of homeownership. All right, we're going to start off with understanding a little bit about this, right? Happy homeowner. Are you a happy homeowner or are you a renter? Because renters, not so much. Look, 52% of renters regret not being able to make improvements. 49% regret no private outdoor space. And 52% regret not being able to have any equity in their home, right? That is a renter. And I don't want you guys not to be happy. That's one of the most important things in life, is to be happy. So what we're going to look at is maybe this. Oh my gosh, is your rent going up? Or do you have like Animal House neighbors, right? I mean, look, we got them. We know what those neighbors are like, and they create so much angst and challenges for a family. And we want to get you out of that. We want to get you in a place where your rent is not going up. But what we've learned since 1988, rents continuously rise. That's one thing that's been consistent since 1988. Rents every year rise. Now, I know each one of you can speak to that. If you're renting, I guarantee you've had some type of increase in your monthly rent. And we want to help you avoid that. Okay, but if we compare renting versus owning, take a look at this. When you rent, you're building your landlord's wealth. Okay, you're building your landlord's wealth. When you own, you get to build your own wealth. Okay, we're going to talk about why that is and how when you make a payment, it helps the landlord versus when you make your mortgage payment, it's going to be helping you. Your monthly payment is likely to increase. We talked a little bit about that as well previously. Since 1988, rents have risen. When you get into a mortgage, your payment is locked in. Your principal and interest payment's locked in. So we're going to go through a lot of things as we unpack this home buying event. Now, millennials, now you guys have paid over $92,600 in rent. Now that's everybody that's age 23 and above, right? 23 years of age to about 35. Now that 7-year period, if you're 23 to 30, let's call it, is about $13,200 annually or $1,100 monthly that you've been paying in rent. Okay? Take that. Just understand that for a little bit. $1,100 in rent for 7 years, $13,000 a year over that period of time. Now, if we look at how important owning a home is, if you look at the 18% said it's the most important, 53% it's very important to them, and 22% says it's somewhat important, that's 93% of Americans, guys, that say it is important to them to own a home. All right? Now, there are some non-financial benefits to home ownership. All right, let's go to the 88% mark first. 88% agreed that buying a home is the best decision they've ever made. 79% believed owning a home has changed them for the better. But let's focus on that top one, right? 93% said owning a home has made them happier. Guys, that's what we said earlier, is it's about being happy. I just want you guys to be happy through this journey. And this is one of the first places in life to start, is owning a property, okay? But let's understand what owning a home means to you. We can look at the surveys and what other people say, but what does owning a home mean to you? Take a second and write that down. Unpack what it really means, because I don't know where you are in this home buying journey right now. You could have perfect income, perfect credit, you could have the assets, or maybe you're on another side and maybe you have some income, but you have some credit challenges. We got to unpack and uncover what your why is to owning a home. Because if it is not big enough, then we're not going to be able to overcome any of these other potential challenges that arise in this buying process. So take a second, write down those whys, that you figure, why do you want to own a home? And let's go through some of the ones that we've unpacked in a survey, okay? A place to raise a family. That is a big one, right? Guys, you want to have your kids running around. You could visualize this. You could see it. Your kids running around the dining room table. They're in the backyard. They're playing. They're inviting their friends over. You got your grandparents there. I mean, all these things are coming into play, and that is one big reason to own a house. An investment. Okay, you don't invest in anything except your landlord's wealth. You don't invest in anything when you rent. So we're talking about this being an investment. We're going to unpack what type of an investment this is and how much it could add to your net worth. And then it's maybe reaching a life milestone. It's about, something that you've really worked hard for all your life. You just didn't understand how easy it was to own a home. And so it becomes a big milestone in your life, you and your partner, to be able to embark on this journey and have something that you call your own. Okay, those are three big reasons that we've found in all of these home buying events that we do, the thousands of people that we've talked to over these years. These are three main ones for them, but you have your own, and I need to uncover what that is. Now, America said that it is the best long-term investment, right? Real estate is. 34% of Americans said that real estate is the best investment over the long term. Now, that doesn't mean you get away from stocks, bonds, mutual funds, things of that nature. It doesn't mean that at all. It just means the long-term investment is in real estate. You need to diversify, okay? Now, let's talk about price appreciation, or how your net worth grows. Just on one side, we're going to talk about appreciation. When you buy this $250,000 home, okay, over 5 years, if you just look at appreciation, natural appreciation, you bought it at $250,000, in 5 years, that property is going to be worth $301,458. Guys, that's $51,458 added to your net worth just through appreciation, just because you bought that property. But that's not the only upside to owning a property and increasing net worth, okay? There are several other reasons, and here are 5, but I'm going to focus on one specifically. The first one is you're paying a payment regardless, okay? When you rent, you're already paying a mortgage payment. You are. It's just not yours. And when you pay that payment, nothing happens, what we call forced savings. It's the second part. So when you pay rent, 100% of it goes to your landlord. The landlord's going to take that rent payment and pay a portion of it to their mortgage payment, to their interest, and a portion of it to their principal. That is savings because you're paying down the principal balance. When you own the home, you're going to get that benefit. When you make your payment that you're already making in rent, when you make that payment, a portion of it will go to interest and a portion of it goes towards principal balance. As your forced savings, that principal balance is going down, and remember that last slide, you're getting the appreciation of the house value going up. That delta is where that significant net worth is coming from, okay? And that's why homeowners' net worth is 45 times that greater of a renter. It's because they're getting the forced savings and you're getting the price, the appreciation, the value appreciation. All right, makes sense, guys? Okay, now let's talk about interest rates. Now, interest rates they've varied. I've been doing this for 23 years, so I've seen them go up and down, okay? Now, you can look at the crazy 80s when they were 12.7%. I mean, if we look at where we are today, now today we're filming this in October 2019. I mean, you're seeing interest rates 3.75, 3.8, 85, 86% interest rates right now. Okay, so we're in an amazing time to be able to buy a house today, just given where interest rates are. But let me tell you, people are still buying. Whether it's 3.8, it's 5.8, it's 12.8, people are still owning homes because it is the single best investment long-term that you can make. It's still better than renting and giving your landlord all that wealth, okay? But we got to make decisions now because where interest rates are so low. It's great because your payment percentage is going to be at the lowest point that it can. You can see how interest rates have dropped since June of 2018 to today at 3.64%. Okay, but when we talk about payment percentages, this is where really look at it. Historically, your payment represents about 21.2% of your income. With interest rates as low as they are, that goes down to 15.7% of your income. That's a significant drop. So you're able to use more of that income to go towards other things and still have the house, the payment that you're looking for. All right. Now, we've established that owning a home is much better than renting. There's absolutely no question about it. Okay. And not even just owning your primary residence, but now we can talk about, like, once you've owned that, getting into investment properties and then finding other people that are going through their life journeys that maybe need to rent for a bit, and then you'll get to capture that as your own wealth builder in rentals. That's going to be another investment seminar that you'll have to attend with me. But we're going to talk about what you're here for, right? Mortgage credit availability. We've gotten to the point where you know owning a home is the best thing. But how do you do it, right? How do you get financed? That's what you're sitting here thinking. How can I do this? That's why you're watching this right now. So let's go through mortgage credit availability, okay? There are several different ways to obtain financing. I'm going to go through several of them with you right here, okay? Now, the first way would be through conventional financing. Now, conventional loans, they're not backed by the government, and they're right now traditionally loan amounts that are going to be at $484,350 and under. Okay, so anything at that amount and under can go through Fannie Mae, Freddie Mac for your conventional financing. All right, now you have government. Now, these are backed by the government, and these are going to be FHA, VA, USDA loans. Now, they are going to be, the loan amounts are going to be different by county. So it just depends on what county you are. We look up that county's specific loan amount. But let's say for Dallas County, I'm just going to use Dallas for instance, it's $395,600. Okay, that is the maximum loan amount you can have. Now, you can have a $500,000 purchase, and we're going to go FHA. You just have to pay it down to $395,600. Now, conventional, $484,350, right? Now, let's say you're not going conventional or government, and you're borrowing, let's say over $484,350. You're borrowing $1 million, right? That's going to be considered jumbo, or non-conforming loans. Okay, now those may be a little bit tighter restrictions on underwriting because you're borrowing more money. And they may have a little bit more of a down payment than what we find on government and on conventional. So those are the three main types of programs. Conventional, which would be through Fannie Mae and Freddie Mac, non-government backed. Then you have the government loans, which would be FHA, VA, and USDA. But they're going to have a little bit more flexible underwriting guidelines than what a conventional would, and definitely more flexible than what jumbo has, but you're borrowing a little bit more money. Now, what happens if we need something a bit more creative, right? A little bit more creative. How do we finance those individuals? Because not everybody is, let's say, perfect in their W-2 wage earner income. Let's say they're self-employed, right? They don't get W-2 income. They file taxes. They're 1099 or they're self-employed. Well, one of the great loopholes within the tax codes is they get to write off a lot of business expenses, right? They have a lot of business expenses. So when we are looking at a W-2 employer or employee, we can take their gross wages, right? We validate through pay stubs. We validate through a verification of employment with the employer that says, hey, you make X dollars, and we get to use that income, the gross income. But when you're self-employed, we have to use the adjusted gross income, basically what you're telling the IRS you really made, right? Gross sales receipts minus business expenses becomes that AGI. That's what we're using. A lot of times, it's not enough money to qualify for the home that you want. So how do we get around that? We do what's called bank statement lending. Okay, we'll take 12 months, let's say 12 months of your personal or business bank account statements, and we'll average the deposits over that period of time. Okay, it's a great program because your bank statements are always going to show more income than what your tax returns are going to show, and that becomes the income that we could use for qualifying purposes. Okay, now they have a little bit higher of a down payment. They're going to start at 10% down. Credit score is right around 600 on that program, but it's a phenomenal program to help you get into a home if you're self-employed and you write off too much income. All right, then there are those that have a ton of assets. They just don't have the income at all to qualify. So how do we get around that? We do things that are called asset depletion pledged assets. Those are where we just use the assets and we do, let's say, a run rate for the next 10, 15, 20, 30 years on your assets to create income. We don't necessarily make you take that income out. We just look at it as a depletion purpose. If you had to take it out, how long would it last? And we can create loans for you guys that have all this money, but just don't have the income, documented income, to show for the purposes of qualifying, okay? And then for those that have no job, they have the assets but no job, and we want to get a little bit more creative because they don't have the availability for depletion purposes, then we could actually do like a 30% down payment, and we could actually do a no job type loan. So there's some really good loan programs that are out there that I will definitely go through you one-on-one. Now, here's a big one, okay? Because a lot of you guys going through these classes want to buy a home, but you want to buy it with the least amount of money out of pocket. You're making good money, but you haven't had the time to save assets, right? And that's where these types of programs come into play. Through the states that we do lending in, they provide grant programs that will allow you to get money from the state, okay, 0% if you really are looking to utilize the grant money to get down the rate the lowest that you can possibly, or just using the money that they'll provide to cover down payment and closing costs. And that'll go from 0 to 7% of what you're financing, guys. And that's stuff that we'll talk about and unpack here in a little bit when we get into cash to close. So we have conventional, we have government, we have jumbo, then we have some bank statement lending, we have some asset-based loans, and we have some grant loans. Now, that's just scratching the surface because there is so much more that we can unpack when you're looking to buy a home, like rehab loans, buying a house, fixing it up without utilizing your cash. We can include all that in a loan. There's so many great things, but we're just going to look at how we can move you down this process to get you to a point where you can fully commit today to take the next step to get approved to being able to buy a home. Whether you're buying it today, you're buying it in 6 months, 12 months, 24 months, we just want to make sure you're on the right path to home ownership. Okay, so here's the big thing, all right? We go through this and everybody hears about this word called underwriting. What is underwriting and who the heck is the underwriter? Who's doing all this stuff? They feel like it's a violation, right? You're looking at all my pay stubs, my deductions, my bank statements, everything I'm taking out. Like, who is this person and why are they looking at? What specifically are they looking at, right? So I want to give you my 4 C's to underwriting. These 4 things are everything that you need to know, okay, that they're going to be looking at, the underwriter is going to be looking at to grant you that elusive approval that you're worried about right now. I know that you're worried and you're seeking it. These are the 4 things that we're going to focus on today, okay, so that you're 100% confident that you're good moving forward to get this approval. Okay, the 4 C's are these: collateral, cash, credit, and capacity. Those are the 4 items that we're going to focus on right now. All right, so collateral. Collateral is the home. So once we've gone through this whole approval process, now you're going to go put a contract on a house. Well, that's the asset. That's the collateral. We need to make sure it's worth what you're buying it for. So let's kind of go through this scenario, okay? We send an independent third-party appraiser out there to give us a value of the home as it relates to, let's say, 6 other homes in that area that have sold within the last couple of months. Okay, within the last couple of months gives us a really good representation of what that true home value is worth. Now, it's got to be like kind of the home that you're buying, right? If you're buying a 2-story with a pool, we want to make sure we can find other 2 stories with pools. If you don't have a pool in it, well, we're going to look, and if another house has a pool, we got to give a decrease in value to that house to take away the value of that pool to add it to yours so that we get a true representation. But let's say you're buying a $300,000 house. That appraiser goes out there, values it at $300,000. Great job. You know the home is worth what you're buying it for. But let's say that house is only valued at $295,000. What happens? Do you still have to buy the house at $300,000? No, you don't. You don't have to buy it at $300,000. Matter of fact, you're going to be able to get with your agent and negotiate that house from 300 down to 295 because I, as a lender, am not going to lend 300,000. I got to base everything off 295,000. So it's going to be my requirement that something has to happen. One, it's either going to get negotiated down where the seller is going to drop the price from 300 to 295. Two, you guys maybe split the difference. You're going to pay $2,500 cash, and the seller will give they'll give credit for $2,500 to get me that $5,000 mark from 300 to 295. Okay? Or three, the seller may not want to negotiate and you love the house. Okay, that's cool. You're just going to have to bring $5,000 more to the closing because I got to get that 300 to 295 to make us as a lender whole so that we can move forward with the loan. So you have options, but I'm going to protect you in the fact that I'm not going to let you buy a house unless you're aware of it. That's not worth what you're buying it for. Okay? But let's look at the other side. Let's say that $300,000 house is worth $315,000. Do we go tell the seller that they need to increase the price of their home by $15K because it's worth more so that you can buy it for more? Heck no, man, we don't do that. That is pure equity that you just got to walk into. You're walking into a home with $15,000 of equity day one. Can you do that when you rent? Absolutely not. This is pure investment, pure equity for you. For purposes when you sell that house, you've just realized that type of gain day one when you've bought that home. So hopefully, guys, that makes sense. Collateral is the house. We send out an independent third-party appraiser to make sure the home is worth what you're buying it for. We're going to protect you if it's under, and we're definitely not going to notify that seller if it's over the actual sales price. All right, collateral, there you go. So the next thing we're going to talk about is credit. Now, 62% of buyers are wrong about down payment needs. What are you? Are you right? Or are you wrong? Are you one of the 62%? Most people, if you look at mainstream media, listen to mainstream media, bad mistake. They're going to tell you you need 20% down to buy a house. Guys, that's not the case. Over 32% of people put 5% down or less. 16% just put 6 to 10% down. That's a significant difference between mainstream media and what they tell you is you need 20% down to buy a home. They also tell you need 720 credit scores, but we're going to get to that next. But down payments, guys, there's so many ways to buy a home with very little money out of pocket. So let's talk about the cash right now, okay? Down payment, VA, okay? These are our veterans, 0 down. No money, no down payment, okay? Then you have USDA, that as well is 0 down. Now, USDA is going to be for outerlying areas that are not typically tied or close to the city. The United States, they have a map that we look at that determines whether the property is eligible for USDA financing, so we'll work with you on that. But that is a 0 down loan as well as with VA. Now, conventional, guys, the minimum down payment for a conventional home loan, 3%. 3% is the minimum down. FHA, 3.5% down. Okay, so those are going to be your down payments. Now, you can put as much money as you want to put down. You can put 20, 30, 40, 50% down. That's perfectly fine. But we're talking about just your conventional and your government programs, okay? Now, jumbo is going to have a little bit higher down payment. Like we said, that's going to start. Now, there are some 5% down programs out there where interest rates are a little bit higher, but they typically want to see solid 10 to 20% down on anything above the $484,350 purchase price. So if we're getting close to that amount, we might do what's called a combo loan, an 80-15-5. This gets a little bit deeper in our conversation, but it's something that we would work with you on one-on-one, where we'd bring the loan amount down to 80%, which would get us hopefully at that $484,350. We would combine a second lien behind that to give us the ability to minimize your down payment. So a lot of creativity and flexibility. Now, there are also grant programs that we'll talk about that can help cover the down payment as we get closer to the credit. So let's kind of unpack this and go a little bit lower. So the next thing after we get through down payment is closing cost. Guys, we have to make sure where that independent third party goes out there and values the property. Okay, they're going to have a fee for that. The title company. In Texas, we're an attorney state, so we have to make sure that we're closing with a title company. They're going to have their fees, okay? Their closing fees, their escrow fees, things of that nature. And then there's something called a title policy, okay? Title policy, depending on who pays that, the seller or the buyer, that could be a significant amount, couple $1,000 sometimes in most cases on properties, $200,000-$300,000 and up, right? Now, the important part about that title policy is it's providing you insurance, okay? So get this. Let's say you bought a house and then 6 months later, a contractor knocks on your door and says, hey, that homeowner that got the house ready to sell to you never paid me. And so I have a lien against the property and I never got paid. You might think, oh my gosh, I got to pay this contractor now. That's what that title policy insures you for. When you buy the home, we make sure with that title company that there are no other liens on that property other than the one that you're putting in place to buy that home right now. So that's your insurance, that's your protection. That's where that contractor would not be able to force a claim against you because you have that insurance policy. So those types of things are going to be covered in closing costs, okay? Now, escrows. Escrows are important because this establishes your homeowner's insurance and your property taxes, okay? So homeowner's insurance is paid in advance. So if you were to buy a house in, I don't know, let's say October, you're going to pay for 1 year of homeowner's insurance in advance, okay? And then we establish 3 months worth of escrows to set aside in an escrow account so that way when the bill comes due next October, we can ensure as the lender and the servicer that there's enough money in that account for us to be able to pay that insurance bill. That way you don't have to write any one big checks because when you make your payment, your insurance is going to be part of that, okay? Now property taxes, that's paid in arrears. So we have to get through all the way through the year, right? And so in December, every year property taxes are due. And then what you're going to do at that point is if you have an escrow account, we're going to be collecting tax payments every single month, just like we do with insurance. We'll set up the 3 months worth of reserves, right? That way there's enough money in there and we can pay the taxes on an annualized basis. That way you don't have to come up with that big property tax check each year. Okay, so that's what escrows are for, and that's going to be part of your total cost. And then we have what's called credits, okay? So guys, when you put a contract on a house, there's going to be something called earnest money. Now, earnest money is making that contract between you and the seller binding. Now, that earnest money is typically 1% of the sales price. So a $300,000 house, that's going to be $3,000, okay? Now, that is money that we're going to deduct from your cash to close. Okay, that's going to come out of your total cash to close. So when you add your down payment, you add your closing cost, you add your escrows, now we're going to start backing out things like earnest money. Okay, there's also something called an option fee. So when you put a contract on a house, just like the earnest money, you're going to give to the seller a check. Typically, it could be $100, $200, $300, something around that number, to give you the right to inspect that house. Okay, do your home inspection to give you the right to basically make sure this is the exact property that you want to buy. Now, that exchange of dollars is going to be for a certain period of time. It could be 5 days, 7 days. Now, during that window, you have to get your inspections done. You have to be right mindset-wise to say this is the house that I'm going to buy. And then if you decide to back out during that window of time, 3 days, 5 days, 7 days, whatever you've negotiated, you lose the option fee money, but you have the right to get that earnest money back. Okay, it's kind of like an insurance protection to that earnest money. Okay, but if you back out after the option fee, okay, after the option period expires, then there's a good chance you're going to lose your earnest money. So I would definitely tell you to consult with your real estate professional to make sure you understand all that. But that money will be coming back to you as well if you don't back out. Okay, so that'll be down payment, closing cost, escrows minus earnest money minus your option fee. So now let's talk about this big credit called the grant, okay? Now the grant is going to be the thing that we would work with you on to get you approved for in addition to the type of loan that you're looking for. So if you're looking for a conventional or an FHA, VA, USDA, the grant is an overlay on top of that, and it allows us to go access funds to cover whatever you would like us to cover as far as your down payment or any remainder of your closing costs. So guys, this is how we get people into homes for little to no money out of pocket. Okay, as of right now, I'm the #1 down payment assistance loan officer for Seth Goldstar in the state of Texas. We do the most down payment program loans for people to help them buy homes. Now, this isn't just for people that have no money. I've had people that have hundreds of thousands of dollars in the bank that have chosen these types of loan programs to minimize their out-of-pocket expense. And it really comes down to me understanding a really important question. How long do you plan on keeping the house? Where is the money coming from? Those types of things is what we look at to make sure when we make this type of recommendation to access this money, okay, that it is a smart decision. Because sometimes these grant programs, they require repayment. Okay, there are going to be all different types of grant programs, and this is stuff that we go deeper with you in a one-on-one consultation. But sometimes these grant programs are going to require repayment for the life of the loan. So 28 years from now, you may have to pay that grant back. Okay, if you got $7,000, $10,000, $20,000, you may have to pay that back. Now it'll come from your equity when you sell the house. Now there are other ones that will only say if you keep your house for 5 years, then you never have to pay it back. Like those. But the best ones are the ones that say, we never will collect the money. Okay, they don't never want that money. Those people that have a couple $100,000 in the bank that we did these loans for, were actually getting in and out of that house within 18 to 24 months. And so they took that grant program that never required any repayment, and they didn't have to access their money that was sitting in investment accounts. So they won on the tax purposes. They won because they used all that money that they didn't have to bring a down payment or closing cost to buy the home. They actually bought it for nothing. And then when they sold the house, they didn't have to pay it back. So these are amazing programs that can help minimize that out-of-pocket expense. We just need to visit with you to see what it is that you're trying to accomplish. Make sure we structure the right analysis for you so we can deliver to you the lowest cost of ownership for the home that you're looking at purchasing. All right, so guys, we just unpacked a big portion of this cash, okay, this mystical cash piece. Now, let's look at credit, okay? Like I said, mainstream media tells you you need 20% to put down. They also tell you you need 720 credit scores to buy a house. And guys, I'm gonna tell you that's absolutely not the case. Okay, so let's take a look at what it takes credit-wise to be able to get approved for a home loan. All right, so if we're gonna do an FHA loan, okay, let's just establish this really quick. FHA has the lowest credit score options, but they have two different types of options. So if you wanna put the minimum down, remember we talked about the down payment, how much was it? That's correct, 3.5% minimum down payment for an FHA loan, okay? But you have to have a 580 or higher credit score, okay? A 580 or higher credit score. Now, if you're below 580, you can go all the way down to 530 on FHA, okay? They're fine with that, but you at least have to put 10% down. Okay, we still at least we can get it done, we just have to put at least 10% down. Now, before we kind of move to the next ones, I want to make sure you understand you have 3 credit scores. Okay, everybody has 3 credit scores: Experian, TransUnion, and Equifax. So as lenders, which one do we use? Do we average them? No. What we do is we throw out your high score, we throw out your low score, and we use the middle credit score. Okay, the middle credit score is the one we're focused on. So when I say 580 or higher, I'm talking about the middle score of 580, okay? Now, when we look at VA just needs a 600 or higher on that mid-credit score to be able to get 0 down payment. On a conventional loan, 620. Okay, 620 or higher will allow you to be able to get a 3% down minimum down payment loan for conventional. And USDA, we're looking at 640 or higher. But guys, don't worry if you're not there, okay? Because here's what we're gonna do. Now, when we look at your credit report, and this is something I've been very blessed, okay? I've provided financing to over 26,000 families, and I'm very happy to say we've never told anybody no. We just tell them not now, okay? Because I don't know where you are in your journey with regard to your credit, but we're gonna have to help you get there. And this is one of the big reasons why I need to understand your why to owning a home, because it has to be greater than what we're about to uncover and have the process that you're gonna have to go through if you're sitting at a 530 and we need to get you to a 600 or a 620 to be able to purchase your home. There's gonna be some changes that you're gonna need to make in your life, okay? So what do? First off, when we look at your credit report, I'm looking at it as to what it is that I need to help you do. We do what's called a what-if analysis. What if, it's a simulation, what if we do this or this or this, and how is that going to change and impact the score, whether it's now, immediately, or every 30, 60, 90 days. What happens to that score? We can go all the way up to 2 years if we make certain types of changes. Okay, that's awesome because now you're on the right path. Guys, I know you have a hope, but you don't have a plan, and that's why you're here. Okay, so if we're talking about having a plan, then I need you to visit with us about getting on that right path. And we're going to help you get there. And you're also going to join, I want you to also join my Facebook group called Hope and a Plan. Okay, it's an amazing Facebook group that we're going to be able to deliver to you real raw material from myself, credit experts, to help you understand what it really is that you need to be doing to move yourself forward in this home buying journey if your credit is not where it is today, where it needs to be able to buy a house. But look, we're going to help you get there. We're going to provide the what-if analysis, and then we're going to make sure you're on the right path. Now, the cool thing with grants, guys, since it is an overlay, okay, we have to use the minimum credit scores that are set for these type of grant programs. So grant program is 600 mid-credit score or higher. You don't need to have 700 or 720s or 680s to access all this money. All you need is a mid-credit score of 600 or higher to be able to access the grant funds to cover your down payment and in some cases, all of your closing costs. All right, so we just unpacked all of the credit, guys. So now we have capacity. This is the fourth C, all right, capacity. Now this is better known as your debt to income ratio. This is where we get responsible lending from, okay? We have to make sure that we're being responsible with how much you're borrowing. We just have to be able to document and demonstrate that you have the ability to repay this mortgage loan. Okay, we're going to do that through capacity. Now, these are numbers, ratios or percentages. So if you looked at the guidelines that are out there, okay, I say the guidelines loosely because there are ways to get higher on these ratios, but I'm going to kind of go over the guidelines with you. So conventional, it's a 36 back in is what they say the guideline is. Now, the ratio is going to be your proposed house payment plus your monthly debts divided by your income. Now, if you're self-employed, it's your adjusted gross income. If you're wage earner, hourly salary, it's going to be your gross income. Okay, but guidelines say that should be a 36%. The reality is on conventional, we can go all the way up to a 49.99 or 50%. Okay, through what we call automated underwriting. Okay, now FHA, VA, USDA is going to be, they tell you in the guidelines, 43%. Okay, so proposed house payment plus monthly debts divided by your income should be right around 43%. Now, USDA pretty hard on 43. VA has a much higher threshold, and it has other areas that we could use, like other types of income that we could look at to qualify you on there. And then FHA will actually allow you to go to right now 56.99% on that ratio, so much higher than that 43%. That's why I say loosely on the guidelines. Now the grant programs are going to vary. They're going to be anywhere between 45 and they'll actually go up now to 56.99. So it just depends on the type of program we're doing, whether it's repay, it's no repay, or it's forgivable. Because there's several different ones out there. We're just going to sit down and figure out which one is the best one for you, but so they have flexibility in their capacity rules. So let's take a look at like a calculation for debt to income ratio, okay? So let's say your income is $120,000. Now this could be combined income, it could be your personal income, but let's say it's $120,000. How we calculate this is we're gonna take that divided by 12 and we come up with $10,000. Now we know the ratio in conventional, the maximum is gonna be 50%. So that means you have $5,000 available of income to use for qualifying. But we have to offset that with your debt that shows up on your credit report. Okay, so your car payments, student loan payments, credit card payments, we're going to take all that into consideration, and then we're going to deduct that from the $5,000. So let's say $1,250. So we have $3,750 available for you to be able to use to purchase a house. So in today's dollars, if we're looking at that, now remember guys, that's 21.2 or 15.7% of your payment goes to your income right now. That's going to get you a $475,000 purchase price with $120,000 in income with $1,250 in debt in today's dollars with minimum down. Okay, But let's say you only are at, let's say $60,000. Okay? So if we take that $60,000 divided by 12, we're at $5,000. Now we're going to look at FHA. So FHA's ratio is 56.99. So that means we have about $28.49 available in income to use. And we're going to offset that with $550 in monthly debt. So that means we have available $2,299 for a purchase price. Now guys, that same calculation will hold a $280,000 purchase price on a home with just a minimum down payment. So now with this capacity piece and the flexibility in the numbers, we've established that you can purchase a much larger home than maybe even what you're paying for in rent today. Okay, so those are pretty powerful numbers, and I would encourage you to kind of go through this calculation yourself. Now, in the payment, and how do we get to that? Now, the payment itself, if we look at it, it has a couple of things. It has principal, it has interest, and then it has taxes and insurance. So when you make that payment, and now we got to that number of $280 or $475, we took the monthly payment, we said, okay, there's a portion that's going to have to go towards principal balance. We love that. That's your forced savings. Then we have a portion that goes towards interest. And then we have a portion that's going to go towards taxes and insurance. So that's what we call those escrows. So when we escrow, you're going to have to pay the property taxes and the homeowner's insurance. Now, depending on where you were, whether it's FHA or conventional, let's say, if you didn't put 20% down, there's going to be probably some mortgage insurance. All that's going to be part of that payment as well. So when we give you your monthly payment, it's going to incorporate all those items. All right? So look, we've unpacked and covered a lot of things. Now it's time for you guys to decide, are you ready to take this next step? Okay, I know you are. The next step is this, okay? We're going to give you a platform where you can go build your profile online. Okay, it's bobmortgage.com. You build your profile online right there. It's super fast and easy. It'll even give you a list of the items that I'm going to need from you. It's very intuitive. So like your pay stubs, your W-2s, your bank statements, your tax returns, all those things. You can upload them securely in my portal, or if you use like TurboTax or you want to connect to your bank, we'll just take in that information so you don't have to upload any statements. Super cool, okay? But if you don't want to do that, then we can actually schedule some time to talk with you, okay? We can have an initial call. And basically what we're trying to understand, guys, is where you've lived and worked for the last 2 years. We want to look at your income. We understand what that is. How much money do you have available to use for a down payment? We got to look at credit. Okay, those are the things basically we're looking at right now when we have this phone call consultation, or if you're going to be building it at bobmortgage.com in my profile for the Apply Now button, that's exactly what you're going to be putting in there. And then at that point, it enables us to really understand what we are looking at, and then how do we help you move forward to achieve home ownership. Now, in that process, a lot of things are going to happen, right? Not only are we going to be looking at and evaluating these things, we're going to start providing you numbers, right? Because that's another important piece to this. We got to provide full transparency so that you understand, okay, if I'm going to buy a $280,000 house, well, what does that look like monthly payment-wise? Okay, how much is principal and interest? How much is insurance? How much is taxes? Am I paying mortgage insurance? And then what is my out-of-pocket expense? Really, at the end of the day, when you add up down payment, closing costs, escrows, back out some of those credits, what am I left with? Do I have that money available? We're going to go through all that stuff for you. We're going to provide it to you in what we call a total cost analysis. That's going to lay these things out side by side so you can compare if we wanted to provide you 2 or 3 different options to give you the lowest ownership cost, or the lowest cash to close, or the lowest payment. We're going to provide all those options to you so that way you can make a sound, comfortable decision. We're going to give you a recommendation, but we want to invite you into that process, and that's what we believe in, is full transparency. Okay, that's all going to happen in that consultation. Okay, whether we do it by phone or you start it online at bobmortgage.com. Then you're going to do those documents. So if we do it by phone, we're going to give you an email list through our portal, okay? And you're going to upload those items in the portal. If you started online first, then it's going to ask you intuitively, automatically, to upload these items, okay? All that then is going to come to my team underwriter. And at that point, guys, This is really where we separate ourselves from many lenders, let's just call it, okay, out there. I understand this is the biggest decision you're making, okay? It's one of the biggest financial investments you're ever gonna make in your lifetime. I wanna use an underwriter. Remember that underwriter that usually happens after you go under contract that you're fearful of? Okay, we're eliminating all that. We're gonna be doing this in the very beginning. That way we can pre-underwrite this file in a way where we remove stress. We provide clarity and certainty to you so that way when you do write a contract on a house, you are supremely confident that you're actually moving into that home because you're gonna get the loan. That's what we do on the front end. So we go a little slower to go fast. We pre-underwrite that file. We ask for items. We validate and verify items because we want to give you certainty. We know you're going to go home and tell your grandparents, your parents, your kids, your neighbors. There's just so much excitement that's out there with buying a home. The last thing I want to do is pull away that excitement because we had to wait till the end to do underwriting. I want to do that all up front. Okay, and that's going to be when I issue you what's called a pre-approval letter. And that pre-approval letter, guys, is what you and your agent will use to go out there and negotiate the best deal that you can get on a home with the fastest closing time because we have pre-underwritten that loan, written that letter, and actually even called the listing agent or the seller on the other side, giving them confidence that you're going to be able to perform in that shorter period of time. And that's how we're going to help you win that deal. Those are that initial steps. Now, once we get a contract, we go into what we call the full underwriting process. Okay, that's the next step. We're gonna have to go back and look at collateral. We're gonna look at the home to make sure it's worth what you're buying it for. Then we're gonna validate all the final pieces of information that you supplied us in the very beginning so that we can issue you the full approval. Okay, that is your full final approval. And then what happens? You go to closing. Guys, this is a day of celebration. This is a day that you've been waiting for, that you've built maybe your milestone, a very important milestone in your life. You've built up to this point, and now we're going to the closing day, and it's a time of celebration. You're going to be signing documents. These are documents that say you're obviously obligated on the loan, right? You're going to make the payments. You're validating and aware that you received title insurance, that there are no other liens on the property. You're aware of the appraisal. Okay, all that stuff's gonna take place at closing. It could take 15, 20 minutes or 45 minutes, depending on how much of a reader you are. Okay, but you'll go through all those items. There'll be an attorney present if you're closing in the state of Texas. And it's just a nice, awesome experience that everyone, I hope, that listens and watches this video is able to experience. That is your closing day. So guys, right now, I want you to go to bobmortgage.com. Okay, it's super simple. Click the Apply Now button. Okay, if you're not ready to apply, you just want to schedule a time to talk to us, schedule the blue button. It says schedule a meeting. Okay, that's cool too. We'll spend 15, 20 minutes with you on the phone to make sure you're ready. But if you're ready and you want to take this next step and you want to see about qualifying to buy a home, whether it's today or it's sometime in the future, it's all good. I just want to make sure you're on the right path. Click on the Apply Now button. It's going to take you to this page. Okay, and you're going to be able to build your profile here. You click the Continue button, and it's a super easy 10 to 15 minute process where we're just asking you questions. You're providing the data. It's intuitive, and it's going to build the needs list right there for you. So when you get finished, it's going to tell you the items that I need from my team to pre-underwrite that file so that you could get that letter, okay, to go be able to buy a house. All right, that's as simple as it is, guys. So look, if you're out there, you want to learn more, you want to engage with me a bit more, you want to know who I am, I'm going to give you a couple different ways because we put out so much content daily to make sure that we're educating you guys, okay? Educating you to be better financial stewards, to be better homeowners, to be better you. And we do that through social media. So Facebook, go to Bob Mortgage, okay? Simple and easy. You want to find me on Instagram, you're an IG person, Bob Mortgage there as well, okay? You like YouTube, love YouTube, go to Bob Mortgage. Guys, you see the trend? I'm Bob Mortgage. This is all I do, okay? We are here to help you own homes. go check us out on the social media. There's a lot of content that we produce to hopefully help you become better at where you are in the life and this journey of the home buying experience. Now, if you have questions, I love questions, okay? Ask the question on social media and just put in hashtag AskBobMortgage. My team searches them, and then we actually answer those questions. It's a way for us to engage with our community. So if you have questions out there, go to social media, hashtag AskBobMortgage. Guys, I really, really enjoyed my time with you here today. Hopefully, it was very much there's so much value that I brought to you that you really feel like you can take this next step, that you feel that transformation from a financial perspective happened right here, right now. And I would love to see you take that next step. Go to bobmortgage.com, click on the Apply Now button, and let's build that profile and get you headed into homeownership.